everyone. It's the top of the hour, and it looks like we have a good amount of people on. So why don't we go ahead and get started with today's session. So right off the bat, thank you for joining. We're really excited to have everybody here today. For reference, I'm Zach Haney. I'm the VP of Strategic Partnerships at Lighter Capital. I've got about a decade almost of background in banking and tech finance. And with us today, we've got Mike Lubers, who's the Chief Credit Officer of Lighter Capital. He's got over 20 years of experience in banking and tech finance, and prior to joining Lighter Capital, he was most recently the Chief Credit Officer at Bridge Bank. So a wealth of experience here as we're going through the topics today with Mike. So let's get started here. We'll set up the slides. And while Mike's doing that, I just want to say, we'll have a lot of opportunity today to go through some Q&A, especially towards the end. So yep, that's us. And feel free to email with any questions, by the way. But effectively, we'll be going through these concepts today. And then Mike will walk us through an example in terms of how to calculate looking at different debt options. And then, as I alluded to, we have some audience Q&A time carved out at the end and some key takeaways. So I guess, Mike, if you'd like to go to the next slide. So the content today is really structured around what's in our new ebook. So you can download it at the link that's on the screen right now. The thesis of the ebook, again, is finding the right financing for your capital needs. This is focused mostly on tech companies, startups, but I think there's some good information out there for a lot of different types of businesses. So right off the bat, let's kind of speak to that. So Mike, maybe you can speak to the chart a little bit here and kind of talk about, for a tech company, a startup, what are the determinants in terms of, where along the x-axis they would fall in terms of incubation, acceleration, growth, and kind of thinking about the types of financing that are available to them at those stages?
Yeah, sure. First off, good morning to everyone. Thanks for joining. Yeah, I think I like this chart because it's really just a quick way of kind of showing a few different things. One is just, these are the different options that we see out there on the financing side, both on the debt and equity side. And yeah, this gives kind of a two-dimensional view of it, looking at, sort of where is the revenue level from the company perspective. What kind of stage they are in their life cycle. And then kind of that dotted line out there throws into effect that actually a third variable, which is profitability, or if you wanted to think about that as cash flow, that's one of the key determinants. So, I think the chart here really is, to give entrepreneurs just a quick view of, what their options are. But maybe let them think about, some of the types of financing probably to seek out, depending on where they are and what opportunity is out in front of them. Obviously, as you get further out or larger from a revenue side or stronger from a cash flow side, the options are going to widen for you. So part of this is to kind of know, hey, if I'm a pre-revenue company, I don't have VC support yet, I'm probably going to be looking for friends and family. I'm probably going to be looking for personal debt, things to kind of bootstrap it. As I go a little bit later on and have developed a product and had some revenue, now my options start to open up. So that's really the intent of the chart. But to your question, Zach, I think the three main things that I would kind of focus on, and most kind of lenders and equity players look at, is your revenue level. And that can be, they can be looking at just size, they can be looking at growth rate, or they can be looking at the type of revenue, if it's one time or transactional or recurring in nature. Cash flow is another major determinant. And that can be, are you pre-profit, are you post-profit? Would you have enough cash flow to service the debt if it is a debt option? Or are you relying on your cash balances, your liquidity cushion to kind of help you cover your burn near term? And then lastly, collateral is a typical item that debt providers will look at. Less so equity, but if you wanted to think of the intellectual property or the IP, that's the real kind of collateral source. for a typical SaaS company. So those are kind of the three main drivers: revenue, cash flow, and collateral.
And in addition to IP, how do lenders look at receivables? And would that apply?
Yeah. So we can get into a couple of examples probably on the next slide, but in the the example of AR factoring, that's what they look at. They look at the strength of the underlying account debtor. So if somebody owes your company $50,000 and it's for a service that's already been provided, and that company is Apple or Google or some reputable firm, a factoring company is going to look at that as a strong collateral source.
Thanks, Mike. So yeah, in that vein, obviously we split between debt and equity here. Why don't we move to the next slide and get a little bit into that?
Sure.
So maybe just provide a little bit of color on how a company or an entrepreneur founder might want to think about debt versus equity, just holistically speaking.
Yeah, I think, at the end of the day, it boils down to the same thing, debt versus equity. It boils down to the return on investment that you're expecting. And so, as an entrepreneur, with every opportunity, that you're faced with, you're assessing what's the return I expect on this and what cost is going to be commensurate with that return. In other words, if the return is 5%, you're probably not going to want to find a capital source that's going to charge you more than 5%, right? Because then it's not a worthwhile opportunity. And the other factor that gets thrown in, which is admittedly difficult to assess, and that's kind of the name of the game for both equity and debt providers, is looking at that return and adjusting it for the perceived risk, right? So it's really risk-adjusted return compared to the cost. So, if you're looking for what a debt or an equity player is considering on their side of it, that's pretty different. A debt player is traditionally looking at a pretty finite return, i.e. the interest rate. And as a result, they're looking at a lower risk tolerance, right? They're going to want a better risk profile because they know that their upside is limited. Their only maximum return is going to be that interest rate. An equity player, on the other hand, is willing to look at a much larger risk profile, but they are also going to expect a much higher potential return. So a lot of times, it'll boil down to, is this opportunity one that is going to provide a huge potential return, risk adjusted? And then if the answer is yes, then you're probably going to have the option to seek either debt or equity. But if that risk profile is such that it's a pretty decent risk level, that's where debt will sort of start to fall out of the picture. A debt provider is going to look at that and say, hey, that's, if you're asking for money to go start a completely new product for which you have no traction, and your historical business doesn't support it from a cash flow perspective, a typical debt provider is going to look at that and say, hey, that sounds like more of an equity financing opportunity, not a debt financing. So it's all about risk and expected returns.
And what about some of the cons from the founder's perspective? Are there things about the taking an equity investment, let's say you're early on an angel round versus a small loan or something? What should the entrepreneur be considering?
Well, I think the biggest trade-off is control. It's ownership percentage. So an equity player is looking for an equity stake, right? So depending on the amount, depending on the perceived risk, depending on the value of the company, that's going to impact how much control that you have to give up in return to get those funds. But again, if you think about it from the perspective of risk return, access to that equity near term has a stronger cash flow implication, right? Because you're not paying back the equity immediately. And so you can use those funds to perhaps accelerate more quickly because you're using all of the proceeds and you don't need to worry about, near-term debt service. But, if at the end of that, you think that opportunity is going to allow you to double in size, but you have to give up 60% of the company to get there, well, you probably would have been better off being at 1 time the size with 100% ownership, right? So it's at the end of the day, it just boils down to that trade-off of that core trade-off between capital and also, access to their networks and their guidance in return for giving up some of your upside.
That's really helpful. Thanks, Mike. So maybe let's move on to the next slide and talk about some other concepts at this point. So just right off the bat, first line there, use of funds. Why is it important to know your use of funds if you're raising capital?
Yeah, and let me go back to the paper. Again, as Zach mentioned, all this is, we're kind of following the outline of the paper. So this section is really about, comparing your different financing options. But I think, we thought it was worthwhile in the paper to take kind of a step back from that and say, hey, here are some things to think about as you're considering the need for capital, right? So what would you want to know about your opportunity? And we think that will help you kind of, again, lead you toward, hey, this might be a better equity play, or this is a strong debt play. So, right off the bat, I think, one of the key things, and it's certainly a key thing for me looking at any, investment opportunity or debt opportunity, is what is the intended use of the funds? And so I can give, a quick example, but the next sections here are going to get into it in more detail. If you're using the funds to bridge you, very short term to some known event, and the easy example is I already made a sale to a company for $100,000. I'm just now waiting for the 60 or 90 days for that accounts receivable to collect. Well, that's a very defined event, and that's a very defined time frame. That should drive you to, okay, this is probably a short-term debt scenario. That's very simple example. Like, probably don't want to go get 100,000 in equity and dilute yourself for some, for an amount of money that you're going to collect in 60 days, right? So that's a very simplistic answer. But yeah, so understanding how you're going to apply those funds, and as we'll get into in the example in the next slide, also understanding what you expect to return from the use of those funds is critical, I think, for determining what's the best path to go forward from a capital perspective.
Mike, we hear growth capital, working capital a lot. Can you expand on what we mean by that, or those two terms?
Yeah. So again, debt providers will sort of break down the use of funds into different categories, and the two main ones relevant for this conversation are working capital and growth capital. And working capital is pretty much the example that I just gave. Working capital is typically something that's short-term in nature. It's something where you've got a defined event, a defined collection amount, but in between now and that collection date, you've got to make payroll, you've got to pay your vendors, you've got to do the things to keep the company moving. So working capital financing is simply, it's sort of like the oil in the gears. It's just meant to keep things rolling. It by itself is not, another way to think about it is a working capital facility by itself will help you get to that defined event and keep the gears rolling. But it's not necessarily going to affect your growth prospects. And another way of looking at that is a debt provider could come in and look at a company with a really low growth profile, but a really consistent growth or revenue story. A working capital financing solution might make perfect sense in that scenario. On the other hand, growth capital is what it sounds like. that's more long-term financing. That is intended, the use of funds is intended to grow the company. And so easy examples of that would be, and one of the examples that we're going to go into in a second is sales and marketing. You know, if you want to use your funds to invest in sales and marketing with the hope that that will accelerate growth, then growth capital financing makes a lot of sense. But it could also be, you know, further product development, you know, R&D. It could even be for equipment, if depending on your company model, if you need to go out and buy a new piece of equipment that's going to allow you to squeeze out a couple of extra percent of margin, which again creates an incremental cash flow benefit. So that's kind of the return on that investment.
That's really helpful. Thanks, Mike. Now let's talk specific to the cost of debt. Obviously, you know, people know APR. We talk about APR. Can you kind of walk us through some of these other points here on the slide about other factors that, you know, may not be tangible costs or maybe are tangible costs, but aren't necessarily just the APR?
Yeah, it's kind of a spectrum. And again, this was one of the main, you know, this is pretty much the main focus of the white paper. It's just to describe, you know, what do we mean by cost of capital? What do we, you know, what we call true cost of capital? And, you know, depending on if you want to view it quantitatively, if you want to view it tangibly, it could mean one thing. We were thinking of it more holistically and a broader, you know, on the tangible side, it's the payback. It's how much is it going to cost to take out this debt if we're talking about debt. And that, you know, that's your interest rate and that's your fees. You know, warrants are an interesting component because it's quantitative, it's tangible, but it's really hard to calculate. And so equity warrants, and we have some papers and blog posts on the website that go into warrants in more detail. We're going to keep a pretty big picture for the purposes of this webinar. But in general, you know, a warrant is allowing that partner to enjoy some of the upside. You know, if the company goes public or if the company sells at some point down the road, a warrant just allows the debt provider to share in some of that upside. So it's a form of dilution. It's a form of ownership dilution. And it's calculated based on the future value of the company. So it's really hard to calculate out of the gate. The best I could suggest on that is, you know, model out what you think your company is worth. If it's a multiple of your revenue, model out how you expect the debt financing to help you grow that value. And then, you know, multiply the warrant by that future assumed value. And that'll give you kind of a sense of what possible cost there is in that structure. But beyond kind of you know, fees and interest and even warrants, you know, we look at things like the structure of the loan, and that can fall into two kind of categories. The simple side is, you know, what's the term of the loan and what's the payback function. So what's the amortization of the loan? And the example that we go into, we'll walk through that in detail. So I'll kind of leave it for then. But, you know, the speed at which you pay back a loan should be factored into your cost of capital, and we'll explain how we can calculate that. The other category of kind of intangibles are what you have here on the slide, which are covenants, controls, or guarantees. So again, depending on what type of debt you're getting, the lender may require financial covenants, may require you to maintain certain ratios. And that's always important to model out because you want to understand, hey, to what extent is this going to constrain me? You know, obviously a lender is trying to be aligned with the company and trying to say, hey, you know, covenant in general should be pushing in the right direction, but it should probably be, you know, set at some sort of floor so that, you know, it protects against a significant negative deviation from your historical experience. But, you know, sometimes those covenants can be pretty strict and it may limit what you can do with the funds. It may limit, you know, to what extent you can invest in growth by, you know, increasing your burn short term. And so those things that sort of constrain the opportunity or constrain the upside, in that way, it can become a pretty significant cost. Those are kind of the four main categories I would throw it into.
And you alluded to control when you're thinking about equity versus debt earlier. But obviously there are some controls in place with debt. So, if you have an equity investor, maybe they take a board seat. If you have a lender that you're working with, there could be these covenants. What are some repercussions in terms of, the covenants and how a founder might want to be treading lightly if they have those in place?
Yeah, well, I think this is a credit guy speaking, right? So, from my perspective, lender capital doesn't require, and very, very rarely do we even have a financial covenant. Our standard model is not to have financial covenants in a deal. But in my prior experience, covenants were a key component of the structure. And the way I tried to frame them, and this is my belief of how you use a financial covenant, it's meant to bring both sides to the table. So the best covenant is one that first, both the lender and the borrower agree it's a key metric to the success of the company. So in other words, management's probably going to be concerned if a KPI drops to a certain level. So if there's that alignment between the sides, that's a good thing. And secondly, it should probably be built to a level where there's some maneuverability if it's breached, right? So if that covenant is set right, usually it's just an opportunity for both sides to get to the table and understand. And repercussions could be as simple as, okay, we get it. Let's go ahead and waive that covenant default. Or it could be, okay, we get it. Let's reset the covenant to the new reality. In a lender's perspective, it's obviously providing a level of protection to say if it's severely falling, then maybe we need to look at, the payback or the structure or, anything else about the loan. So, they can have real repercussions, but it's really important just to understand what's your lender's reputation and what's your lender's motivation by structuring it the way they have.
That's really helpful. Thanks, Mike. And just thinking about use of funds and then weighing that against, these terms like term of a loan or amortization. I think this is a good segue maybe to the example that you'd prepared. So why don't we flip over to that?
Yeah.
And then just a little housekeeping while Mike's getting that ready to speak to this example slide. Yeah, please feel free to keep loading questions into the Q&A box, and we'll get to them as we're going through the example here if they're relevant to the example, or we'll try to tackle as many as we can at the end of the presentation after the example. But yeah, Mike, do you kind of want to walk us through what's going on in this scenario here? And just for the audience, this is the first one in the ebook. So this is right out of the ebook.
Yeah, exactly. We've got three different examples. What we tried to do in the paper was say, hey, these are some of the terms you're going to want to look for in competing offers. And, if you've got two companies that are offering you pretty identical structures, it's pretty easy. But what we found is that borrowers usually are presented with a range of offers, and sometimes, they'll get things that are pretty different from one another. And so that's why we thought this first example was a good one, because it's comparing, two loan types that might make sense. Either of them might make sense in this scenario, but they do have some key differences that are worth pointing out. So, like Zach said, this is in the ebook, but let me just give you the rundown real quick, and then I'm going to transfer over to Excel and show you kind of how I would look at things. So this company, it's a SaaS company generating about $150,000 in monthly recurring revenue or ARR, or sorry, MRR. Its investment opportunity is to hire some sales folks to take advantage of some leads that they've generated. Obviously, the cost is the cost of those salespeople. So it's defined here as about $100K per year per person. And then they go out and they look and they say, okay, we think this is a good debt opportunity. It's going to provide, an incremental growth rate. They're expecting that, they can in total grow their revenue about 10% per month. So they're looking at that as saying, you know, the size of the opportunity, relative cost. Let's go see what we can find from a debt perspective. So the two offers, one is a short-term MCA loan. So MCA is short for merchant card advances. And so this is a loan product that provides funds up front and then takes a share of revenue after that until they get to some preset amount. So in this case, the term sheet itself says, we're purchasing your future revenue worth $230,000 at the cost of $200,000 minus a closing fee of $5K. So on the Excel, I'll go into how I would frame this. But the short thing is, or the short summary is, they're going to give you $195,000, and then you're going to pay them back $230,000. And the way you're going to pay them back is by a percentage of your monthly revenues. In this case, 15% of your revenue. And actually, in this case, they're taking it directly on a daily basis. So if you get in $100 in day one, they're going to take their $15 and then remit you the remaining 85. The other example, the other option, excuse me, is just a straightforward term loan. So $200,000 given to you up front. They state that they're going to charge you 20% per year in interest, and they're going to get paid back over a 36-month term. So principal plus interest paid monthly. So that's the setup. And let me first kind of, you know, to go back to the prior slide, let's think about, you know, some of the questions we want to ask ourselves. First is, what's the intended use of the funds? So is it working capital or is it growth capital? So this example is pretty obviously for growth purposes. The company's already got a set amount of revenue. What they're looking for is they want to invest in some salespeople to grow their revenue. So again, that's going to give you a clue. Is this a short-term opportunity or is this a long-term opportunity? Meaning, you know, what's the return? Is it just, you know, the collection of the receivable, or is it the incremental cash flow that you get from those revenues over a period of time? Go ahead, Doug.
I was going to say, Mike, merchant card advance, the first option here. You know, buying future revenue, that sounds kind of like factoring. Maybe for the good of the audience, you can explain how it differs from factoring that you talked about earlier.
Well, it's not tied to specific receivables. It's really just them saying, hey, we're giving you 195. Now we're going to take a cut of all revenue that's coming in. Factoring, on the other hand, would say, you know, you have a receivable for $100,000. We'll give you $85,000 today, and now we own that receivable. And so when the receivable collects in 30 or 60 days, you know, the factoring company keeps the money. There's usually some other mechanisms in factoring, so it's not, you know, there's other fees and other things, but that's kind of the difference between factoring and NCA.
So merchant card is more forward-looking on revenue, and factoring is more on services rendered.
Yeah, that's a great way of thinking about it. Yeah, okay. The factoring company is just that's factoring company looks at it and says, hey, whatever happens to the company, this receivable is due, right? And that's why they look at the type of revenue, and you know, the easiest thing is that I sold this company a widget, they have possession of the widget. The money is owed. There's no disputing that the money is owed. So yeah, that's a great way of thinking of it. Is factoring kind of looks backward at something that's already happened. MCA looks at the go forward revenue expectations and ties their repayment to that.
That's really helpful. Thanks, Mike. Back to the yeah.
Yeah. So yeah, I kind of already answered this question. What's the expected source of repayment? Well, in this case, again, if you think of it like an investment, which it is, if you're hiring a salesperson for $100,000, you're expecting that they're going to generate more than $100,000 in profit, or in net revenue, I should say. If they're not, then it's not a great investment. So the source of repayment, if you're looking to finance that cost, is the cash flow that cost will generate. In this case, it's the net revenue that will be generated from that salesperson. So you think about, and I'll go into it in more detail and when we get to the Excel, is how quickly is that money going to come in? So that's kind of a key component, understanding the timing. And depending on how you understand the timing, that's going to drive you to one loan type over another, if that makes sense.
Absolutely.
And then the last question here, which we will definitely get into when we model, is what's the cost of capital? That's the end all be all. How do I compare these two examples? So let me skip down in here and get over to Excel real quick. And hopefully everybody can see this. Sit down beforehand. I think it looks okay.
Yep, that's great, Mike.
So again, there's a table in the white paper, and the prior slide, showed the setup. So I'm really right now, I'm just saying, hey, in order for me to compare these two loans, I'm a credit geek. I want to model it out. I want to see how they look compared to each other. And so I thought would be useful, it would be to share how we do that. First off, I wanted to start by showing the company as it currently stands. So this isn't exactly in the example, but as I'll show you later, the numbers all will add up. I just sort of expanded on the example so I could illustrate it in more depth. So this company is doing okay. They've got, starting, like we said, about $150,000 a month in revenue. I made up an expense load and said, okay, this company isn't quite to profitability yet. But I also made the assumption that let's assume that their existing sales are growing at a sort of a flat clip month over month, about 15K in additional. So the company itself, on an existing basis, if they didn't invest in this new opportunity, this is what it would look like. And then, for small SaaS companies and startups and the types of companies that we look at, their cash cushion is huge, right? And you'll hear it referred to as, what's the company's runway? So how much money are they losing and how much cash do they have? And if you project that forward, how long is their runway? When would they run out of cash? So I made up a cash balance and compared it to, the operating profits here. And I highlighted this guy, $25,000. That's your low point. So a little bit outside of the scope of the white paper, but I'm a credit guy. I can't help myself. If I were looking at this situation, I'd say, okay, if the company can do this, the company is going to look great. However, it's going to get pretty tight on cash before it gets there. So again, runway is one of the key metrics that most debt providers and equity providers look at. And if I were assessing the runway here, I'd say, okay, they've got, an expectation of getting down to 25,000 in cash. And if I were to look at the average burn, say over the last 3 months, it's $25,000. So that implies a runway here of about 1 month. Again, it's not hugely relevant to today's discussion, but I did want to say that because it will set us up when we get a little bit further into the example. So the second thing I would do is let's layer in the new investment. And so I showed this, a little bit differently than what's in the example in the white paper, to illustrate this point that you really want to try to assess the opportunity by itself. What is the cost of this opportunity, and what incremental revenue do I think I'm going to generate from this opportunity? So I made up some assumptions here, but again, the numbers all foot with the model. If you looked at combined revenue between the existing business and the new revenue, this will all foot with the example in the white paper. On the cost side, I just made up some assumptions. I said, well, let's assume I want to hire 3 salespeople. Take me a couple months to get them interviewed and accepted. So I have them staggering in over the first couple months. And probably, somewhat understandable. Let's assume there's a bit of a sales cycle, a closing cycle. In other words, the salesperson isn't going to come in day one and instantly start generating revenue. They're going to need some time to ramp up. So that creates the cash flow kind of outlook for this investment. And in this case, what you see is, fully loaded, there's about $25,000 a month in cost that needs to be covered. And in this model, it takes you all the way to month 7 before you break even, before the revenue is expected to generate at a high enough clip to offset that $25,000. So that's sort of the expected return of this opportunity. Or I should say the kind of the timing of the return. So then I just added together, what's this impact? How would this impact cash balances? So what you see obviously is that there's an upfront cost with this investment before you get to a break-even point. And the net result is that now you're not sitting on $25K of cash. Your low point in cash would be $1,500. So a really confident, entrepreneur might say, all right, I don't need that. I can go finance this myself. Yeah, if everything works out perfectly. But I would look at this and say, that's really, really risky to expect things to happen exactly to plan it. And $1,500 is just way too low a cash cushion. So if I were looking at this, I'd say, okay, we need to finance this opportunity. The opportunity looks great. Looks like it's going to return decent monies pretty short term, but we need to finance it. So the third tab here overlays both of the loan options. And so if I start with loan option 1, which was the MCA option, again, the loan proceeds are $195,000. So they say it's $200,000, but then they say they discount, they take a $5,000 origination fee. So your net proceeds are $195,000. And then the way the repayment works, as it was stated in the term sheet, is they're going to take 15% of your daily revenues. Obviously, I'm just calculating it monthly here. So that's what this number is showing, is 15% times your revenue. Now you'll notice something. It's taking 15% of all of your revenue, which is fine. That's how Lighter Capital looks at a revenue-based loan as well, as we look at your historical revenue rate to help us understand the repayment. But it is worth noting because day one you've got 150,000 in sales, so they're gonna collect on that 195. They're gonna collect 22.5 in the first month. If you did the math on what your projection is, you're going to show these revenue or these loan payments each and every month. The way the deal is set up is it says you'll pay us back at this clip until you get to $230,000. So that's what the sum of this row is, and what this means is you're going to pay back this loan in 8 months if you hit your plan. And that's, the existing revenue hitting plan, and that's the new investment hitting plan. So I'll pause and say, one of the advantages of, an MCA facility or a revenue-based loan agreement like Lighter Capital offers is that there's flexibility. If it takes longer for these revenues to ramp up, it's going to mean that this number is slightly lower. Also, if you're off on your existing plan, this is going to afford you a little bit of flexibility. So there is some upside, certainly, to having a payment that's tied to revenue.
And Mike,
Um,
that's 15% of total revenue, so that includes the new revenue they're generating as well as the existing
yeah,
business.
yeah, exactly. So, but if you're confident about your plan, or if you say, hey, the worst case is these are pushed down a couple months, this is a pretty quick payback, 8 months. Now, here's where we get into, it's not just about the cost, it's about timing. If I look at the combined cash flow, so this investment by itself is not going to generate positive cash flow for a while, and I'm going to be paying back the term loan, or the MCA, sorry. This is my burden. This is how much it's going to cost me in net cash flow, this opportunity. And, again, doesn't hit break even until, early in month 9. So if I look at the combined cash balance, inclusive of obviously the loan proceeds, you get down to $14,000 in this scenario. Again, I would look at that and say that's way too tight, given the size of this company and given its monthly expense level. That just seems like too low a number to me. So when I get down to the bottom, when I show the loan comparison, I'll hit this point again. But that's why I think it's always important to kind of model these deals out, is you kind of want to understand where's your cash balance going to be. Now, not to go too much onto a segue, but imagine also if the loan had a financial covenant that said you will maintain runway of X, or you will maintain minimum liquidity. All the more reason to run your own models to understand, what's expected to happen. Let me pause there. Zach, is there anything you think I should clarify there?
No, I think that's really helpful, just in terms of, you want to kind of know, especially relative to the operating expenses in the business, when cash gets really low before the revenue really ticks up and I'm starting to generate cash, how tight is it going to get? Am I going to miss a payroll, or have to defer supplier payments? Can I make my cloud payment? I think those are important things an entrepreneur should be thinking about.
Right. So let's go into loan option 2, and so then we can start to compare and contrast. So again, it's a $200,000 term loan, and it's structured at 20% interest with a 36-month amortization. So I ran the amortization schedule here, and if a lender is offering you a term loan with a stated interest rate, it's pretty quick, pretty easy to calculate the amortization. But if you want to ask the lender to help you with that, that's totally reasonable. But the first thing you see here is that this is 36 months. So the payback on this one is much longer. So what that means is that, the payments are really low relative to what you'd be paying with the MCA. So again, there's pluses and minuses. I'm not saying that one is inherently better than the other, but that's a pretty big distinction. So as a result, obviously your net cash flow is going to look a little bit better in the near term in the loan option, in the term loan option, than it does in the MCA option. And then flip side is you're going to be paying this term loan back for a long time. So, once you get past the repayment of the MCA loan, obviously its cash flow position looks slightly stronger. But then the key kind of takeaway here is look at your cash balance. So on a combined basis, because you're getting $200,000 up front and you don't need to pay it back or you're paying it back over 36 months, your low point in your cash balance is significantly higher in option 2 than it is in option 1. And I would argue, I actually would argue this is still a little bit tight, but it's much stronger, relative to the size of the company and size of the expense load. So let me start to hone in on some, ways that I would start to compare and contrast. So obviously, you can visually see, hey, this one's, if I hit my plan, I'm going to pay it back really quick, and that's going to eat into my cash. a couple things and a couple things that are noted in the white paper. One is the interest rate. So it might be tempting when you look at this deal and say, okay, it's a $200,000 facility and I'm going to have to pay back $230. That's a 15% interest rate, right? 230 divided by 200 is 1.15. And then if you had, if you were say comparing that to the term loan, it's at 20%. So your first reaction might be, okay, 20% versus 15%. I want to take the 15% deal. The second thing to note is, I've already kind of talked about the cash cushion, but let's look at the kind of matching of the use of funds and the incremental cash flow. If you're looking at, I'm using this $200,000 to pay for the sales staff. Well, first of all, you're going to be paying that money out in increments, right? It's not like you're going to expend this full $200,000 day one. If you look at this model, and you just kind of sum this up, basically you're able to pay for about the first 9 months of cost through the $200,000. That's one way of looking at it. But if I look at the incremental cash flow, this deal starts to pay for itself in month 8, right? I'm generating $12,000 in incremental cash flow, and it's costing me $8,200 in debt service. So I'm able to, just through this investment itself, cover my cost. Whereas in the MCA loan, you're never at that point. You're using the profits from your existing business, and even to a certain degree, you're eating into your existing cash cushion to pay back this MCA loan. So this is one of the points the paper is making, is that you're not really fully utilizing the 195. Cash is fungible, but you can almost look at it as if you're using some of the proceeds of the loan to pay back the loan, which is maybe not the most efficient use of capital. So again, knowing what you're going to use the funds for and knowing what the cash flow situation of that investment is, I think is important to then say, can I align my repayment of the term loan with this source? That's how bankers look at it. That's how lenders look at it. They try to match what the funds are going to be used for with what the return from that investment is going to be, and they tie their repayment to that. So in this example, the term loan is much better aligned with the investment itself. Not to mention that the term loan provides a lot more cushion. So if these numbers are materially off, or this number is materially off, you're going to have some built-in cushion in the term loan. You'll have some incremental, like I said, incremental cushion on the MCA too, because it's a function of the revenue. But I would argue that there's probably more room for error in the term loan facility because of the lower, slower payback.
Mike, on that note of cushion, this is a question from the audience. How, what's an acceptable level, or how should an entrepreneur be thinking about that, or, what's safe?
Yeah, what's safe? It depends, but because runway can be calculated a million different ways. Am I looking at that month's burn compared to the cash, or am I looking at an average of the last 3 or the last 6? But in general, when I worked at Bridge Bank, we would start to talk to the borrower when it was getting under 12 months. And we would probably start to get a little nervous when it was under 6 months. Now, if you're looking at a venture debt facility, or even the revenue-based financing that Lighter provides, that's part of why we're getting a different return than a tech bank is getting, is because we're probably more amenable to having a tighter runway. But if I were running a business, I would be, I'd be thinking about what my plan is when I got under 12 months. And I would hope that I had a plan lined up at 6 months. So runway of 6. But like I said, the slope matters, right? If you're looking at a 3-month look back and you were burning 100,000 3 months ago and you're only burning 10,000 a month, in the current month, your 3-month look back runway is going to skew you low, right? And so the flip side, if it was a runway of 6 months and your burn in the current month was worse than it was in the prior month or the prior month or the prior month, if your burn was getting worse, that's going to be much more meaningful, even if your runway is 6 months. So it's a calculation. 6 months, I'd say, would be, a good rule of thumb as sort of a minimum that you'd want to maintain. But it does kind of depend on, the trend line of your burn.
And for the purposes of this example, before thinking about taking on debt, can you just walk us through just mechanically how you're calculating row 16, just looking at how tight cash gets without taking on a loan option? Just like mechanically, how is that number coming together?
Oh, yeah. It's just, so the starting cash balance was $100,000. You lose 40,000 on the existing and 8,000 on the new. And so that's 48,000 burn. So your combined cash balance at the end is 52,000 bucks. So it's just the prior month plus the sum of these two rows. That's the formula.
And that's why it starts ticking up in month 4, is now you're generating positive cash on the existing business before the new lead hires.
Right.
Got it.
Yeah, and hopefully I didn't screw up my formulas. If somebody's doing the math and if I did, I apologize. But that's the concept, obviously, that we're getting through there.
And so just to recap, then, as I'm thinking about these two loan options, you've got the merchant cash advance and the term, and obviously very different payback features if this project takes off. What are the comparison box at the bottom? Can you quickly kind of walk us through what are these mechanical things that you calculated?
Right. So at the end of the day, some of the concepts that are mentioned in the white paper are meant to give you a way of getting to an apples to apples comparison. So, the key one that, let's just walk through them one by one. Cost perspectives. Loan option 1 is cheaper than loan 2, just from a pure dollar perspective. So, on loan option 1, it's 35,000 bucks, 230 minus 195. Loan option 2, if you did, the math of 36 months of getting interest payments on a declining loan balance, the sum is about 62,000 bucks. So, you want to know that number. But then the next piece is, again, related to time. And APR, which I'm sure everybody's seen on their credit card statements, it's your annualized percentage rate. So again, all it's trying to do is calculate things on an annual basis so that kind of apples to apples. So that's really important to note on this deal because, again, as modeled, the MCA loan pays back in 8 months. So that's where I was saying it's not, the sum of the amounts paid back divided by the original loan is 15%. But when you think about how quickly they're getting paid back, the APR is much higher at 46%. And again, hopefully I didn't screw up my formula, but it's just there's an Excel formula you can use to calculate your APR. Whereas with the term loan, it's pretty much the stated rate. So your interest rate at 20% is effectively your APR because it's stated as an annual interest rate. So if you're worried about, just the cost of capital, this is a closer representation of your cost of capital, in which case option 2 is a better deal than option 1. NPV is pretty nominally different in this deal. I use a an inflation rate of 3%. And I just took, hey, what's the sum of all my future interest payments brought back to the present? And so with a MCA loan, because it's only an 8-month payback, it's pretty close to the total cost. It's not going to differ much. Because the $62,000 is paid over 3 years, then net present value of that makes a difference. So why would an entrepreneur care about, a finance term like NPV? I think that's one of the key things here is, let's assume that this proceeds exactly as planned. If you had $122,000 in the bank and you hadn't even in theory exhausted the loan proceeds yet, in this version, if you just look at this number minus these guys, this net cash flow, you still have cash proceeds or loan proceeds available to you. Whereas in the MCA version, because you're paying it back so quickly, you exhaust those proceeds before the investment even gets to cash flow break even. One way you could look at this and say, that's an opportunity. I have an opportunity to reinvest those funds into, now maybe I hire a 4th salesperson. So having that cushion allows you to consider opportunities to get a higher return on the investments that you see fit.
And Mike, in that vein, if the entrepreneur was happy with how things were working out and still had all this excess cash, what if they wanted to return some of it, on the term loan option?
Yeah.
What does that mean for cost of capital if they're paying it off early?
Yeah. Well, I built this example for that to illustrate that point too. So I'm glad you asked. You could do this analysis before taking the loan, and one reasonable item could be, I really am going to be okay if this number is more like 50K instead of 122K. So maybe I don't need all of it. Maybe I don't need a $200,000 loan. Maybe I only need $125,000 loan. And maybe I'm comfortable with cash with my plan dropping to that level. So modeling first allows you to say, is the loan amount the right amount? If you wanted cushion up front because you weren't as confident in the plan, and then you got to this point where it was working exactly like you thought it would, with an MTA, if you prepay it, you're still owe the $230, right? Depending on how the term loan is structured, maybe there is a prepayment penalty for early withdrawal, early payment. Mm-hmm. But you can do the math on that and say, hey, is that prepayment going to allow me to save from a net present value perspective? If you don't think you can utilize those funds to get a better return than 20%, in other words, you might be better served to pay down the term loan. So that's something that you could either try to negotiate into the term facility structure as an allowance for a prepayment. Just keep in mind that the lender is in the business of making money too. And so that's usually where it ends up being saying, hey, we're setting aside these funds for 3 years to get this payback. If you guys pay us back tomorrow, we might not find another investment that's worth 20%. So we need to find some sort of middle ground. So that's usually how, a prepayment fee is negotiated. It's somewhere in between.
And that would be at the onset of the loan, right? Someone should know what that would be so they can calculate it when they're taking on a facility.
Yeah, exactly. Like I said, you might do this analysis before deciding on the loan, and you might decide you want more or you want less. Or if you decide you want the amount, you might want to negotiate in some sort of prepayment fee, sort of early buyout to allow you to take advantage of an upside situation.
And that would be, again, at the behest of the entrepreneur negotiating with their lender.
Yeah, yeah, exactly. I mean, the takeaway here is there is no such thing as like the perfect loan. I mean, this would give you a good framework to go back and say, hey, with MCA, can I get that reduced to 10%, not 15%? because I'm, when I'm mapping it out, I'm worried that my cash is going to fall too low. Or with the term loan, you might say, hey, this is great, but I could actually afford to pay it back quicker than 36 months. And, 20%, I'm not sure I'm going to always find that investment opportunity that's worth keeping the 20% debt outstanding. So, maybe I take a different amount, or maybe I try to negotiate a way to prepay it if my cash flow situation is hitting plan. So modeling it out is usually beneficial in my book, not only to assess how I would compare two different offers, but then to see what you can negotiate with the lender. The flip side is the lender is doing all of this presumably because of the risk they see in the deal. And so that MCA provider might have assumed 15% because they're not modeling this. They're modeling a slower growth rate. They're, and when they do their internal return, they're looking at this number, or they're looking at, their IRR and saying, hey, I need to get paid for the risk that I see. So it doesn't mean you're necessarily always going to get what you want by just handing them this model and saying, look how great it would be if I could get, 15% instead of 20%. But at least you understand the mechanisms of how those different structural elements play into your cash flow position.
We just had
that's ultimately at the root of it.
Absolutely. And we just had a question talking about what kind of sensitivity analysis would be reasonable then on these revenue streams. Like this is obviously an idyllic scenario of everything executing well. How else on a downside, should an entrepreneur be thinking about this in terms of how tight it might get?
Yeah. And, it's going to differ obviously from an entrepreneurial standpoint and probably from a debt provider standpoint. But, what I didn't build here is the prior 12 months. So if I had, when we're underwriting a loan, we're looking obviously at the history, and that's a big driver to us of what the future is going to look like. Not to get in the weeds on COVID, but obviously that's one of the issues with COVID that's impacting the lending world right now is, well, we can't look at the past to predict the future. We're in this time period of uncertainty. But in general, if we looked at the historical numbers here and that company was growing at a very consistent clip, it's going to mean that our sensitivity is probably going to be less on the go forward. Let's say that this company was at 150,000 for the last 6 months. Now we probably would be saying, well, why wouldn't I just assume it's flat at 150? So the sensitivity, the range of the sensitivity, I think, is relative to the assumptions of the model, frankly, not to get too vague about it. But history is a good starting point for how you build your model going forward. But yeah, usually the way we look at it is kind of 3 versions, sort of a best case, most likely, and a downside. Mm-hmm. And on the downside, usually if we're cutting revenues, in our forecast, downside forecast, we're also looking at the expense structure. Obviously, we didn't go into any depth here of what's in this 190, but we take a lot of time to understand what the expense structure is, what's really crucial to drive that next dollar of revenue, or if your revenue scales down, can you scale down your expenses in line? So the downside sort of, can play a couple different roles. It can see, how far before things would break, if there's a financial covenant, say, or also, what would I do if this top line didn't hit? What would be my action plan? And those are all kind of the key underwriting due diligence questions that we ask on any deal that we're underwriting.
Thanks, Mike. Maybe we flip back to the deck to kind of close up here as we're a little past the top of the next hour.
Sure. Hold on a second. Let me get my...
All right, and just another recap on the housekeeping. We will send a copy of this webinar, a video recording, as well as a link to the ebook to all the attendees and registrants that signed up for today's session. So just a little quick audience Q&A as we jump around here. Mike, we talked about covenants earlier. How might the COVID scenario that we're in be impacting how companies are triggering covenants or breaching covenants? What types of covenants would be at play relative to the COVID economic environment?
Well, yeah, the range of covenants is pretty unlimited, so it really depends on the company. But let's take a simple, example, or a couple of simple examples. One might be a profitability measure or a cash flow measure. And, again, there's really three components that you would look at. There's what's COVID's impact been on the top line? How has the company reacted from an expense standpoint? And third, was the company able to generate liquidity through PPP? We were very upfront with our borrowers and our prospects saying, if you can get PPP funds, get PPP funds. A relatively inexpensive, relatively flexible, capital option. And so, if you breached a covenant because your revenues had declined, the lender is most likely going to ask, what are you doing about it, both from an expense side or, what's your prospects for seeing a rebound on the revenue side, and what kind of cash cushion do you have to absorb it? So PPP would help address that last question, and your game plan around the expense structure. Those are really the two things. And we're talking to all our borrowers, and we're looking to be as helpful as we can. Again, we don't have financial covenants, so it's not exactly an apples to apples comparison. But those are the two things that we're asking about. We're like, what's your plan, both on the top line and on the expense side? And, do you feel like you have enough liquidity cushion to ride through this?
What about customers or companies out there today where some of their clients want to be active, still subscribing to the service, whatever that may be, but those clients are furloughed? What kind of depth would a lender be looking at in terms of churn related to clients that have, furloughed their employees and are temporarily caught and balled?
Yeah, we've had borrowers in that situation that were significantly impacted because of, the industry segment that they played in. And it's all about what's your action plan and what's the reasonable expectation of when revenues come back. And that last question is super hard to answer. We're in the same exact boat. But if management has taken the right steps to furlough or whatever other expense structure moves to minimize that burn in the interim, we're working with those borrowers now. An RBF structure, a revenue-based financing structure, which was Layer Capital's first and primary loan product. In certain ways, that loan product is built for an environment like this, because as the revenues go down, so does the payment. So the debt service is automatically sort of adjusted for the new reality. But what banks are doing for term loans or other kind of fixed payment type loans, if they're seeing that you guys are deferring, lenders are looking at how can they restructure those payments, deferrals, re-amortizing it, different things. Now, I would say that maybe that deal where you didn't have a strong covenant, there's usually some sort of trade-off, right? So if the bank's saying, hey, we're not going to take payments for the next 3 months, they might say, but I want to make sure that cash doesn't drop below a certain point or cash flow doesn't get below a certain point. Again, that's usually the conversation you'd be having around, what's your action plan? What are you doing on the company side? hopefully it's a partnership that you have with your lender, and hopefully both of you guys, both sides are aligned on how to get through it. To me, it's modeling and communication and, the logic of, hey, if this happens, here's our plan. If that happens, here's our plan. That always goes a long, long way for us internally. When we talk to an entrepreneur and they're like, yeah, I'm on it. Here's all my different kind of scenarios and modeling. That's usually helpful.
Maybe that's a good segue to the next slide then, just as a recap as we start to close here. So obviously these are the three main points that we really tried to hit on today and are relevant to what's in the ebook. It's really important to know the use of funds, know what you're using the money for, calculate all the costs, not just the stated APR, but, total interest, what are the intangible factors, like controls and covenants. And to Mike's last response to the prior question is really know your capital provider, right? You're in this with them. There's a lot of uncertainty in the market today. It's important to know that they're going to work with you in case you breach a covenant or if other factors, impact the business, and they're willing to hang it out and kind of work with the business as it works through this kind of uncertainty period that we're working through. Mike, do you have any comments related to that?
Yeah, I would just tie that last point back to, kind of the example that we showed. Sometimes a lender can look at an opportunity and say, yeah, let's provide this loan product because it's going to give a great return. But the entrepreneur is like, this doesn't really fit. That's what I was trying to show in the example, right? Is that maybe one loan type fits better than the other one. They both get the job done, but they create different costs of capital and different constraints. But it goes both ways. I think a good lender is going to say, hey, what are you using the funds for? What's your plan? What are you looking for? And then say, have you thought about this? Maybe this loan structure makes more sense given your model. So I've found that if you can find that lender that is acting, in an advisory role, saying, hey, this looks like it fits better with what your investment plan looks like. That typically means it's a borrower or a lender that's, interested in the relationship side and building something that's going to last longer. It also probably means that they've been a little bit more thoughtful in how they're, approaching the opportunity as opposed to trying to fit a square peg into a round hole.
Thanks, Mike. That's a good note to end on. And if we go to the next slide, we'll be posting a poll here shortly just for attendees that are still with us on how the session went for them today and what they got out of it. Hopefully it was useful for everyone. As you may be aware, this is the third webinar that we've hosted in a series. And the fourth one will take place in about 2 weeks. And our Chief Sales Officer, Patty Elliott, will be hosting. And we'll also have Brandon Bornanson, who's the CEO and founder of Seamless AI, and Wani Rao, our VP of Product as well here at Lighter Capital. And the overall thesis or topic of that session will be 12 performance indicators, as you can see, for startup success. So definitely metrics you want to keep an eye on as you're growing the business. And then, Mike, the last slide, just as some people may be aware, we kind of ran short on time to get to everybody's questions. So we'll look at the ones that were submitted and not answered today, and we'll also field as many as we can that come through this email alias, lcwebinars@lightercapital.com. And again, please be on the lookout for a follow-up email that have a recording of this session, a link to register for the next webinar, and a link rather to the ebook. Thank you.